Okay, hello everyone. This is Mapletree Logistics Trust Q2 FY 23-24 financial results dated 24th October 2023. So this is the latest update, right? So we'll just go through the key highlights quickly. Year-on-year revenue is up 1.5%, NPI 1.2%, DPU 0.9%, right? But we'll see later that actually quarterly DPU dropped, right? So portfolio occupancy is high at 96.9%, slightly below the previous quarter, which I think is okay, right? So average rental revision is up 0.2%. It's basically flat lah. But they say that if you add China in, right? If you take out China, right, the rental revision is very impressive at 9.1%. So the rest of the portfolio is doing very well, except for China, right? But you can think of it as all the positive performance from the rest of the portfolio is actually taken away because of China, such that there's more or less no change in the rental revision, right? Leverage is below 40%, 38.9%. Okay, debt hedged into fixed rate 83%. So this will prevent further rate hikes, or at least further substantial rate hikes. The parts that are not hedged will still increase in interest rates. Right, so we can see the divestments made are all above valuation. Right, this is a positive thing. It means that their assets are probably valued conservatively, and actually in reality they probably can sell for more money. Right, so this is really a positive thing. That the real NAV is probably higher than what is actually reported. Right, so let's just go quickly year on year. Right, so this quarter versus a year ago, quarter two, right? The higher contribution from Singapore and Hong Kong and acquisitions is offset by China, right? And of course, the divested properties. Okay, so and of course, currency depreciation, right? This is what issues with investing in REITs with foreign income, right? Normally, SGD strengthens, so when you convert back, you lose some in revenue in terms of exchange rates, right? So they tried to hedge this, so to minimize this depreciation. Right, so property expense increase. This is not surprising. The last few reports we've looked at for other REITs also the same thing, due to higher energy costs, water costs, and other things like inflation. Right, so constant currency basis, gross revenue and NPI will increase 6.1 and 5.7% respectively. Constant currency basis means if there's no depreciation of currency against SGD. Right, so this will be the performance, which is quite good. Right, borrowing cost is increased. We expect this, right? I'm not going to go through this one because I think it's more or less the same, right? We just want to look at available DPU lah. So you see that it's improved by 0.9%, 0.5%, but this is the one that really is not so good. So you can see that in front the highlights. Sometimes you have to be careful. This one is reported Q1 to Q2, right? So quarter on quarter, but this one is reported year on year. Right, so you see that they report positive 0.9% year on year, but in reality, if we compare quarter on quarter, it's actually a 0.1% drop. Right, so even though existing properties are doing better, right, acquisitions contributed, depreciation obviously not a good thing, right? So SGD strengthening again, right? Property expense again increase, all right, and borrowing cost increase, right? So all these things are what actually caused the DPU quarter on quarter to actually drop, right? So actually, I would look at this figure as what is the actual performance versus the next nearest performance, which is Q1, right? FY 23-24, right? So I probably would have looked at this figure. Rather than the 0.9% earlier, right? Yeah, which is a year-on-year figure. Right, so anyway, we look at debt, right? So in terms of debt, NAV is 1.42, unchanged from previous 3 months ago, right? So this is the latest NAV, is the same, right? Interest coverage ratio is 3.8%. This is quite good considering the situation that we are in now of higher interest rates, right? So nothing too much to say about this, right? Debt is well staggered. There's a little bit of debt left to refinance, right? But they already have the available lines to refinance. So I don't think debt-wise they should be an issue, right? They try to hedge their interest rates, 83%. In the CICT slides, I thought hedging wasn't a good thing, but I have reconsidered my position and realized that not hedging is quite risky lah. Even though, of course, not hedging has its upsides if interest rates go down. But I think as a someone who manages a REIT, you should be prudent and try to mitigate against any form of downside as much as you can. So I think I take back my words from the CICT's presentation where I said hedging the interest rates doesn't expose the REIT to the upside, but it also doesn't expose the REIT to the downside, which I believe is the right thing for a REIT manager to do. Right, so I think hedging is the correct approach now. Right, and forex, 80% hedge to mitigate the depreciation for foreign currency into SGD. Right. So so this is, again, go back to the geographical diversification. There's good and bad about this. One, we have to look at this REIT and think that actually it's well managed, right? But the exposure to China means that this thing underperformed and dragged the rest of the portfolio down. In some way, that is the upside of diversification. The fact that if they were solely invested in China, I think this REIT will have underperformed by quite a lot, right? You expect that maybe the drop in performance is something like 10-20% possible, right, in terms of DPU, right? And because of the rest of the portfolio holding it together, right, that's why the performance is more or less flat, right? So that's the upside of diversification. The downside is I find it difficult to understand so many markets, especially places like Japan, South Korea, and Australia, right? So it's really difficult to think about what's happening in all these places. The other way to think about it is if you buy this REIT, I think you trust that the manager is doing the right thing in taking care of shareholders, right? So I think that's more or less all, right? You can see just from occupancy that China is the underperformer, right? Again, all of these things are not meant to be financial advice. It's just what I think at this point of time, and it may change with time, right? So with that, thank you for your attention. Right, this is the end of the presentation.